Good evening, everybody. Welcome to the Center for Independent Futures informational webinar on integrating tax planning into your overall plan. My name is Dick Malone, and I'm the Executive Director of CIF. We are a nonprofit based in Evanston, Illinois, committed to meeting the needs of individuals with disabilities to achieve independence and fulfilling lives. We collaborate closely with families using our person-centered approach to enhance independence through coaching, experiential learning, and shared activities. We're pleased to partner with Protected Tomorrows to provide information tonight about a very timely subject, tax planning. Mary Anne Ehlert is the founder of Protected Tomorrows. She's a financial professional and sister to an individual with disabilities. She is highly regarded as a specialist working with families of individuals with disabilities and serves on the boards of several organizations, including the Special Olympics of Illinois. She speaks at conferences nationally and locally on planning for families with special needs. Our speakers will leave time for questions at the end of this presentation, so please save them up. So if you have a question, please feel free to put them into the chat box. And just to let you know, we will make a recording of this event available to attendees after the presentation. Thank you for being a part of this evening's session, and we look forward to learning more about this topic tonight. So welcome. Marianne, to you.
Okay. Welcome, everybody. I'm excited to be here. And we are talking about a topic that is probably not necessarily near and dear to everybody's heart, but an important one. And the one thing I do know is people have a lot of questions about this topic. And so today we hope to answer some of those. I have a special guest with me too, Amy Floyd. She is with PBG Financial Services, and I was thrilled to meet her, to hear about her expertise, but I'm going to let her introduce herself so you can hear more about who's going to be joining us. Amy?
Hi, I'm an attorney in private practice. I also work as a consultant for PBG Financial Services because I've been doing trust tax preparation for about 30 years. My area of expertise is generational wealth planning. I work with families to make certain, not so much that they grow their wealth, I leave that to the financial planners of the world, but protect their wealth, and especially protect their families. I want this money to go on to successive generations. So I do everything I can to make sure that you have the right documents in place and the right strategies.
Okay. And can you say a little bit about your special needs practice and how you've learned what you know?
Right. Years ago, I worked for a Northern Trust Company as a guardianship, estate conservatorship administrator. And that was my first introduction to special needs planning. And from there, it was an area where I was fascinated by the various trust documents that could be drafted that would allow people to protect their families when they were no longer there. My son just married a young woman who has a sister with special needs. And as part of their talk, I encouraged them to be a little bit more broad in their thinking because her sister is going to become a permanent member of their family. They will take on the responsibility. And so now I'm very interested and really want to make sure that everybody gets the right information.
Well, thanks. So I'm really glad Amy's here. She's going to back me up because she has a lot of technical knowledge, and we'll get started. So just thought I'd share a little bit about my story. Why do I do this? Many of you who've heard me before know that I had a sister who had cerebral palsy, and she grew up. My parents got her diagnosis when she was 2. My parents pulled me aside. There were 6 children in the family. They pulled me aside because I was the oldest girl. I was 6. And my parents told me on that day that Marcia had something called cerebral palsy, that they didn't know what it meant yet, but that she would need care for the rest of her life, and that I was going to be her big sister, and that was going to be my job. And I thought it was really cool because I didn't know when I was 6 that meant I was going to have lots of responsibilities in the future. But she is who taught me everything that's really important. I watched my parents struggle through taxes like we're talking today, and what did this mean and what did that mean and what do benefits mean? And so it's after I got through the corporate world and the financial world, I thought, oh, I'm going to help families, because if my parents were confused, everybody had to be confused, because they were, very, very active at Clearbrook. My sister lived there for 9 years. And I learned about from them what they really wanted for her life. My sister unfortunately had a seizure in her sleep at the age of 39 and couldn't turn over and suffocated in her sleep. And from then on, my parents talked about what they always wanted for her. I heard these stories. So here I am, hoping to pass on some of those things I learned from my parents and the thousands and thousands of families who've told us their stories. We've been doing this for 35 years. And so the one thing we do know is our lives are complex, right? We have to do what everybody else does, but then we have to throw in special needs trusts and government benefits and special other legal work. And we have to file for guardianship when our child gets older. And then we are trying to do in our taxes, and we're getting these benefits and we don't know if they're taxable or not. We don't know what to do with them. And to find an accountant or a CPA or a professional who knows it is pretty limited on this planet. I know when I started 35 years ago and I said, I'm going to become a financial professional and work only with families who have a child with a disability, my peers all said, wow, you're never going to make it. There aren't that many families. Well, here we all are. And we know that there's many, many of us who, but I'll tell you, the professionals out there don't believe that there's as many of us as there are who are so confused about this. So I'm really glad Amy's here, because to find people who know it is a gem. So our mission is your mission. Same thing. We all want the best thing for our family, for our families, for our children. And so that's our purpose. And tonight it's going to be about tax time. So let's get started. So what's so different about your taxes in the world of disabilities? Why are we here? Why can't you just go to H&R Block or a local CPA down the street, or the attorney who does simple legal work? Why can't you ask them these questions? It's because it's complicated and not everybody needs it. And as we learned when some of the questions that came up that got asked of me when knowing I was going to speak today, we got asked some questions and we ourselves had to go research some of those questions, and the answers aren't apparent. They aren't there. So it's different for you because it's not always apparent of the things you need to do. Okay, so we're going to get started with some very specific questions. Some of them I'll answer, some of them I'm going to turn over to Amy. But the first one we get asked a lot is, can I claim my adult child who has a disability as a dependent on my tax return? Amy.
So we have a general rule regarding when you can claim a kid or a child. Obviously, the child has to be a U.S. citizen. They can't be claimed as a dependent on somebody else's return. You can't claim your spouse as a dependent if you file jointly. But specifically with regard to an adult child, the answer depends on if they have lived with you for more than half of the year, that you have provided at least half of their support for the tax year, and they're either your child, your stepchild, a sibling, your brother, your sister, father, mother, grandparent, and they are not filing a tax return of their own. That's when you can claim an adult child with a disability on your tax return.
Okay, that's a pretty straightforward answer. So remember that. Remember, this is recorded. You have that question. You can go back and listen to that, because we get that question a lot. So I'm going to answer this one. If I claim my adult child as a dependent, will it impact their government benefits? Sometimes. Remember that when we are applying for SSI, we are applying for some of those benefits. The questions are, do you have support? Do you have any kind of special support? And if you are providing some support, enough support to them, if they can be dependent on your return, you might have an impact to your benefits, right? Amy, you want to add to that?
Yeah, in particular, I think what you're talking about is providing food and shelter those things could potentially take away from the, is it SSDI payment or SSI payment?
SSI payment, right?
Yeah, SSI payment. So you want to be careful and know what those limit numbers are to make certain that you don't go over the amount because you don't want your child to be penalized.
Right. And remember, certain things are called in-kind support. So it's not always just about the money, it's providing a place for the person to live. If you're providing a place for them, that's in-kind help. So you've got to be careful with all of that. Can I claim my child as a dependent if they're living in a group home? Are there situations where I can or cannot?
So this one's a really interesting one because IRS considers a stay at a group home to be a temporary absence. As long as it's deemed to be a temporary absence, you're allowed to claim the child as a dependent. But the question is, what is a temporary absence? IRS says if it's illness, if it's due to education, business, vacation, or military service, it can be deemed to be a temporary absence. But if you do not expect the child to ever be able to return, and they will always be in a group home, then you won't be able to claim them as a dependent. And you kind of have to weigh this too with how much does it cost to support your child in that group home? And are you in fact providing more than half of the cost of their support so that you can also meet that test as well?
Right. Because sometimes your child could be living in a group home, but you are and maybe getting some funding, but a lot of times you're paying more than half the support. So you really have to look at that test. So I'm going to ask the question, why does this matter so much? So there are benefits that come with things like pensions, right? So if I'm a teacher in Illinois, I have a teacher's pension. Did you know that the TRS pension, if I pass away, can go to my spouse? But if my spouse passes away, there is a benefit under TRS that if I have a child with a disability, they may be eligible for that pension benefit. So for many, many years, and this is things that, you know, as parents, we need to be advocates forever. We're not doing it when our child's up till they're 10, till they're 18, till they're 28. We're going to always be advocates. And this is one of the reasons why. Up to this point, some of these pensions would say that the child with a disability can get the pension on the death of the second parent. So if I passed away, my husband gets it, my husband passed away, my son gets it. Well, then all of a sudden, that pension regulation had a little addition to it. And if you didn't know that that language is added to that pension, so in the pension document, there's something that says if you have a child with a disability, they can get part of your pension. Now what it says is, if your child has a disability and when you die, they're dependent on your tax return, then they can get the benefit. So if they're living in a group home, which is our goal to get our children, you know, set and financially secure, they're living in a group home, and therefore they're not probably dependent on your tax return, they are no longer eligible for that pension. So what you thought, many times we used to say, okay, great, you got the pension. We're going to make sure that that's documented. The pension had to be payable to a special needs trust and special language in the special needs trust. We went through all those hoops. And then if you don't pay attention to those little changes that might occur, you might have assumed that they're going to get it and they're not. So that's why it matters. All these little things matter a lot. So it used to be that when I took a person as dependent of my tax return, I got deductions. And then pretty soon they took away the benefit of the standard deduction, right? So why would I care if my child's a dependent of my tax return now? Amy?
It's amazing. When you're able to claim the child as a dependent, you get a significant amount of deductions. If this is a child that you've adopted because they're special needs, you get an adoption credit. You can get an earned income tax credit for parents with children with disabilities. You get a child independent care credit. You're able to deduct health conferences that you attend to learn more about the disability. You get medical expenses that would include special school instruction, home modifications, attendant care. There are some really wonderful IRS publications, and I don't often praise IRS, but I want you to know about it. And Marianne and I are going to give you a list of resources. But the one that I want you all to make note of right now and write it down is a publication that is known as 3966. 3966 is a 3-pager, and it tells you all the things you can qualify for if you are the parent of a disabled child. And it also gives you a publication number that will explain in much greater detail what all these deductions are. It makes it much easier for you when you have this kind of resource available, because if you're meeting with an attorney or a financial planner or some other advisor and they don't think you can do certain things, you can quickly point, I've got this IRS publication 3966 and it says, here's what I can do. So please prepare my return accordingly.
So how would they find this publication, Amy?
You go onto the internet, and I think pretty much, even though a lot of us don't want to be internet savvy, we have to be, at irs.gov. That's the website. Type in irs.gov with a search bar, or click on publications and forms and then type in the number. So this one happens to be publication 3966, and it's the key to all of the other publications to deal with questions regarding being a parent, having a disabled child, or having a disabled dependent.
Great. And most people don't know these. You know,
No.
sometimes we get tax returns, I can be looking at somebody's tax return, they told me to went to a conference, and then they start telling me other things. I'm like, oh, what about this? So it's important. Okay, so let's go through some examples that people ask all the time. My child is receiving SSI. Now remember, SSI is the benefit your child gets when they turn 18, unless the parents have low income and low assets. The child becomes eligible for SSI and they're getting their $943 a month or whatever they're getting. Do they need to file a tax return, the child or the parent? But usually we're talking here mostly about the child. Does the child need to file a tax return for the SSI? Amy?
So
could be the parent.
The question, can you hear me? Okay. So the question is the SSI going to impact anything in filing a return? Because SSI on its own is not considered taxable income. So the question of whether they need to file a tax return is going to depend on whether or not they have the base amount for a child filing, which is $25,000. So we'd be looking at Social Security benefits. We'd be looking at any of the other child's income to determine whether or not they have enough so that they're required to file. But if all they have is SSI, SSI is not considered taxable income.
Right. So that's really important to remember, that SSI is not taxable income. But now they're getting SSDI, Social Security Disability, or DAC. Remember, SSDI, someone's getting either because they have worked themselves and have some work credit, or they might be getting DAC, which is Disabled Adult Child Benefit, which is a benefit you're getting on your parent's record. You know, your parent is disabled themselves. If they die or if they retire, there's a benefit we'll apply for the child. It's called DAC. So if the child's receiving SSI or DAC, do they need to file a tax return?
They have to add these numbers together with any other taxable income. And as long as that amount is at least $25,000, they will be required to file. It will be taxable to them up to 50% of their SSDI if the child's income is between 25 and 34,000, and it could be up to 85% of these benefits if their income exceeds 34,000. So once again, add them all together, and if they hit that $25,000 mark, you're going to need to file.
Okay, so we're going to go through some specific examples. So my son works, and he's got a job, but he's also getting SSI. So he doesn't make so much that he loses his SSI, because remember, our SSI goes away if we make too much. but he gets his 943 minus some amount because he's got this job, but he's only making a small amount. I'm helping him. How do I fill out his W-4? And has that changed? And will he need to do a return?
When the government did away with personal exemptions, they really messed with us on the W-4 form. The W-4 form doesn't look anything like it used to look. We used to be able to just put in a number, claiming 1, claiming 0, claiming 2. Now we can't do that anymore. It asks you a series of questions and you have to actually fill out the form. First question is your information, name, address, filing status, social security number. Then question number 2 is you have to indicate if you have multiple jobs. Question number 3, do you have any dependents? Question number 4, are there any other adjustments? Then you sign and date it. And based on that information, your employer, your son's employer, will decide how much to withhold. Bottom line, if all he's getting is SSI and a small amount from this job, the only way he is going to get a refund is to prepare a tax return, where he shows that he is not subject to tax on his earnings, and then he can get the refund back. Filing the tax return, he will not claim himself as a dependent, so you still will be able to claim your child as a dependent. He's filing the return solely to get the refund.
That's an important point, I think, because they might be filing, and sometimes you say, well, can I still claim that child as a dependent? Well, they're just filing it, not because they have income, but because they have money that they should get back, right?
Correct. Yeah.
Okay. Oh, here's another one. So my 26-year-old son is getting SSI, but he has a job making $500 a month. So obviously some of his SSI, he's not getting all of it anymore. He's reporting his 500. Now SSI requires you to report your paycheck every month. You have to report what you've got paid because they adjust the SSI based on your income. So if you make 500, 85 is free. The rest is counting. And that money that's over and above the $85, half of it is taken out of your SSI. So your SSI is reduced by making money, but they're not taking any taxes out of his check. Should he file a tax return? And if so, why?
So in this case, he may have to file because he has a statutory obligation to file, not because he's trying to get a refund. But what's even more important is if he files because he is making income, he can qualify for the earned income tax credit. And that's something that if you can't take him as a dependent, he should be claiming himself and also filing for an earned income tax credit so that he can get a refund on his tax return. That is a refundable credit that will be paid to him.
So it's really interesting. The earned income tax credit was not being used. I mean, people didn't know it. Their child was getting SSI, they're making some money, they're not taking taxes out, or they may be taking a little bit out. And I was on the board of the National Disability Institute, and we had a project. And the project was, how do we get our young people who have a disability, who are getting a benefit, who are making some money, who really should get this tax credit? Because a tax credit is not money you paid in. It's money you're getting, it's not a refund, it's money, right? And so there was a project, it was probably 15 years ago, where the Disability Institute created free tax sites, which now still exist. And all it was for is for individuals with disabilities to go file their tax return. And they would go there and file those. Millions of dollars over 5 years was put back into people's pockets because they took their child to this site, or the child could go to the site, get a free tax return, and they got this money back. It was amazing. And it was one of the first times because the head of the IRS came to our meetings, our board meetings, when we were doing this project. And it was one of the first times I realized the IRS could be good guys because they were really interested in doing this project. And it was fun to watch the number of people who got it. So since then, I've been really aware of this tax credit, and not like you hear people being told all the time, well, my child doesn't make very much and they're getting SSI, they only make $300, so I really don't have to do a tax return. And that's just lack of knowledge sometimes on a professional tells people they don't have to do it. So it's a really good point to remember, please. Okay, so now my son is 26 and getting SSI. but he's making only 200 a month and they are taking taxes out of his check. So he's only making 200 a month and they're taking some taxes out. Should he file a return? And if so, why?
Once again, he's probably not making enough to actually file a return so that you can still claim him as a dependent. But the only way to get that refund, the taxes that they're taking out of his check, is to have him file the return. So that's very important. Otherwise, the money just sits with the government and nobody gets any benefit from it.
So a couple things to watch for if your child's getting SSI or any kind of government benefit. SSI is not taxable. SSDI and DACA are. You need to know if they're getting a paycheck and if there's money being taken out of their check, and you need to know if they're eligible for a tax credit. Now, if the parent is being able to file the child as a dependent, they both can't take the tax credit. Is that true?
Correct. Only the person who claims the child or claims the dependent. So if he's filing his own because he has enough income and he's required to file, he'll get the earned income credit. If he is filing a return only to get a refund, he's not claiming himself, then the parent will be allowed to claim it. And when the parent claims him, the parent will be entitled to the earned income credit.
Okay. So I hope that's helpful. If you have a situation that's not one of these, put it in the chat box. We're going to look at them at the end and see how we can help answer some of those. But these were some really good examples of typical scenarios that we see. Okay. So this is the other big thing that's so confusing. When applying for SSI, in order to get the full amount of SSI, because you're living at home, you're the person with a disability and you're living with your parents, I was told I either have to charge my adult child rent or use the fair share approach. What's the difference?
All right. So charging them fair market value or fair rental value of a room in your house, you're going to have to do a little research and find out what is the fair rental value of a single room in a home in a particular location. Could be $400, could be $600. That's fair rental value. With reference to fair share, you're going to actually have to figure out how much it costs to run your entire home, how many people you have living in the home, all the expenses to maintain the home. So you're looking at monthly expenditures for food, for rent, for mortgage, for property taxes, for heating fuel, gas, electricity, water, garbage collection, dividing it by the number of people who live in the home. And then that will actually come up with what is the fair share for that particular person to live in that home. And
if the fair share is too much, you got to go back to that rent scenario.
Correct.
Because if your fair share is more, then you're not going to get your SSI because you're getting subsidized.
Right.
Right.
But then people worry about the fact that when you charge them rent, it's taxable income.
Right.
It is in fact taxable income. But what people don't realize when they kind of freak out about this is you're allowed to take deductions against that rental income for what it costs you to provide that property. So it's almost as if you get to take a fair share deduction against the fair rent. And a big deduction that a lot of people tend to ignore when they're thinking about this is depreciation on their home. So if they have a $500,000 home over a 28-year period, an annual deduction for that is roughly $2,400. So that $2,400 depreciation deduction can offset the amount of the rent you receive, along with what it costs you to provide insurance and real estate taxes and maintenance expenses and water and heating. More often than not, you end up with a net rental loss on your tax return, and that can only help you.
So what happens with that depreciation? Because I've heard that if you take depreciation on your home, it impacts you when you sell your home.
IRS, this is when IRS is not helpful and not nice. The rule about depreciation is magic words, allowed or allowable. which means that if you were allowed to take it, but you didn't, they're still going to charge you with it. So the minute you take rent, you are supposed to take depreciation. And what depreciation does is it reduces your cost basis in the home. So we were talking about that $500,000 home. When you take $2,500 of depreciation against it, your cost basis in that $500,000 home is now reduced by $2,500. And at some point in the future, when you sell the home, whatever that reduced basis is because of depreciation, it's that number that you use to go against what you made in the sale to determine whether or not you have a taxable gain on the sale of the home.
Right. Of course, we have to.
But you don't have any choice with
Right.
depreciation. You have to take it.
So, but you have to remember, sometimes capital gain on the sale of your home is not always a bad thing, because there are exemptions when you sell it. If you don't sell a home every year, if it's your home and you're going to sell it and you're moving to another house, but you live there long enough, there's lots of rules around that. And you know, as a couple, there's a lot of money that you can have as gain that you don't have to pay tax on. So make sure you're working with someone who understands those rules, because you don't have to. It used to be in the old days, oh my gosh, I got to keep all my expenses, what I spent on the house. If your house has gone up by $1 million, yeah, you got a problem. But if it's gone up by a couple $100,000, you're not going to have.
So it's a $500,000 exemption for a married couple every 5 years. It's
Right.
your primary residence. Right. So if you're single, it's $250,000 that you do not have to pay tax on.
Yeah. Okay. Thanks. Okay. Another favorite topic is Medicaid waiver funding. This is really confusing because it gets into, we know that if you choose home-based funding, you're going to get pulled. In Illinois, it's called PUNS. You get pulled. You're going to get some funding. You're going to choose if it's going to go to SELA or home-based. And if you take home-based funding, a parent, you can either use that money to go get services, right? Or the parent himself, or you could do both. The parent might be paid as a personal support worker. So let's say mom and dad are living in the house. Dad works, mom maybe has a part-time job, or she's a stay-at-home mom. Your child is pulled and you get waiver money. And it's about, let's just use $2,000 a month. So it's about $24,000 a year. And mom is getting $24,000 a year to be the personal support worker for the child who has a disability. Is mom taxed on that $24,000?
The IRS issued a ruling, 2014-7. I love this ruling. It provides guidance on tax treatment of certain payments, and they refer to these payments as, what's it called? Difficulty of care payments. If it can be classified as a difficulty of care payment, and by the way, IRS in this ruling said Medicaid, home and community-based services waiver programs are in fact difficulty of care payments. They are not includable as taxable income. Don't have to pay tax on it.
So if you're doing your own tax return, all the software asks you that question now. Even in the beginning, it didn't, but now it does.
Oh, good. Glad to hear that. But the important thing for you to remember is you have to provide the care in your home. There was a notice put out, and in this notice, 2014-7, IRS gives you 19 examples. And they're not all of the examples we could come up with, but a really good cross section of what you're going to be facing. And they tell you exactly if what you are doing counts as difficulty of care payments or not. So whether it's tax excludable or not.
So when you're doing the tax return, is there anywhere you have to write on the return that it's a difficulty of care payment, or what would a parent do to make sure that they get that as tax exempt?
So IRS has given us some guidance, and I think it's kind of fun that they're doing this because it's not written in any tax program, but there are blank lines next to where you report this income, because you're just going to report it. Let's say they gave you a 1099 through some agency. They pay you and they give you a 1099 miscellaneous or a 1099 non-employee comp. 1099 is just a notice to the government. Hey, I paid some money to Mary Smith over here. It is now up to Mary Smith to tell the government what that is. Right on the line where you include the 1099 amount, you can write on there notice 2014-7, difficulty of care payment. You could write Medicaid waiver payment, but more often than not, IRS will recognize notice 2014-7, difficulty of care payment. And that's all you have to do to describe it. And then you can take it out as a negative amount on another adjustment line with the very same label. And that's how IRS knows.
So if somebody gets a W-2 for this payment and they take tax out, what would you do with that situation?
Exact thing. You include it as wages. You show the amount of the income tax that's being withheld on the tax return, because you get to get all of that back. And you simply make an adjustment. And I believe the adjustment line is approximately line 14 on the face of the 1040. Whatever was on that W-2, you make it a negative amount on the adjustment line, and you tell the government it's because this was a difficulty of care payment.
So everybody got that? Because it's a big question that we get. So now let's talk about these funds were paid to the parent. Remember, it's not taxable income if your child's at home. Remember that, write that down, not taxable income. But I'm going to tell you, it is earned income. Now, this is where it gets really confusing. So I'm not paying tax on it. But when I go to apply for Social Security, let's say I'm the caregiver at home, I'm getting this $24,000. I'm not paying tax on it, but I'm getting to $24,000. It's earned income. Can I, first of all, say I have earned income and I can make a Roth, because you have to have income to make a Roth contribution? Yes, this is earned income. You can use it as income in order to make a Roth contribution, Roth IRA. The downside of this earned income is you're now decided you're going to go for your Social Security. And you have, you're applying for your Social Security, and you're going to take your Social Security before you're age 67 or 66, your full retirement age. Do you remember how Social Security works for us? If we're going to take Social Security and wait until we're our full retirement age, which is most people about 67, you can, and once you're 67, you can make $1 billion and take your Social Security, right? You wait 67, 68, 69, 70. You'd never not take it past 70, because 70 is the max it's going to go up. But what if you decide to take it at 62? And we're going to talk about reasons you might do this. Well, if you take it at 62, 63, 64, 65, and 66, you take that Social Security, do you have to report this income as earned income? Yes, you do. We have verified it with Social Security. They count this as earned income. And so now, if you're getting $24,000 a year, and Social Security says, oh, you're making money and you're taking your Social Security early, we are going to give you a reduction of your Social Security. And that reduction applies forever. You're taking it early, you get this deduction of your Social Security because you're making money. And so be aware of that. So what might we do? Dad is working. Mom is a stay-at-home personal support worker. But they're both at night, dad's providing the care. They're sharing the job, but mom's got the full-time job typically. Mom's going to apply for many reasons. She might decide to take her Social Security early, but she's got this income. And she's got the income because she's the employee. And who's usually her employer? Many times, it's dad. Dad's the employer or another adult child in the house, and mom is the employee. Well, maybe we're going to make the other person the employee, and mom becomes the employer. We can switch those roles before you apply for the Social Security, so that mom, was the support worker, is now the employer. She doesn't have earned income for Social Security. Now, there are many reasons that we're going to apply for Social Security at some point, and some of those have to do with Medicaid and Medicare and getting Medicare for your child, which we'll cover in a minute. But I just want you to remember that Medicaid waiver money is in fact not taxable, but it is earned. And so it's really a strange concept, but it's the way it works. So let's talk
One
about-
more comment I'd like to make on that one
Uh-huh.
is that 2014-7 notice I was telling you about. Question 9 specifically says that for purposes of the earned income credit, this Medicare waiver money is earned income, and you can qualify for the credit just because of that.
So the earned income rule is it has benefits, has some downsides, but it has probably more benefits if you can adjust who's the employer in place. So remember, taxable income, yes. Taxable income, no. Earned income, yes. Those are the answers. Okay. All right. We're going to come back to that in a little bit. Okay, let's talk about special needs trust. They're so confusing. Everybody knows that we can't leave money directly to our child, right? My parents had when my parents were planning for my sister, they got advice. All you have to do is leave Marcia's share to Marianne, and we'll be all set because Marcia can't have any money. Well, what's wrong with that? Leaving it to the other child is not an answer. If my parents had left it to me, it was mine. I could have taken it and gone to Hawaii. I could have gotten in credit card debt and they would come after my sister's money. Let's say my parents left me $50,000 for my sister. What if I thought my husband was a really good guy and I put it in his name and my name and something happened to me, right? Well, then we file for divorce. What happens to my sister's money? Just putting money in other people's names in order for our child to keep benefits is not a good idea. So we get this special needs trust. It's a special kind of trust that we can leave money for our child when we pass away. We set them up, we put money in them. We're going to talk about who funds these different trusts, what kind of a trust is it, and who pays taxes on these things. I get questions like this all the time. So we're going to talk about each trust. The trust on the left is called a discretionary special needs trust. In different states are called different things. It's not really what the name of it is, but the trust on the left is called a third party trust. Third party meaning the money going into it was never the child's. It was maybe the inheritance I'm leaving for my child. Maybe I'm setting up a trust and putting money in it. The money it is for my child's care. It's for their supplemental care over and above what the government pays for. And when my child passes away, I get to say who gets it. So I have a trust set up. I have a son with special needs as well. I have a trust set up for Mark. The money is there for his future. And when he passes away, I'm leaving it to his heirs, his brothers. I'm leaving some of it to the charities that have helped him in his lifetime. He's living in a residential program. He gets all kinds of services. They'll get some of it, right? The other kind of special needs trust is a trust that is mistake money, I call it. It's an oops trust. It's a payback trust. So that if somebody left my son money and he's getting his benefits and it's money he couldn't have, I can have this payback trust set up. His money goes in it. It's spent for care. And when he passes away, the state gets reimbursed for Medicaid in that trust, and the remaining will go to his heirs. So there's a reimbursement on that trust. We're going to talk about each one. And I know the next class is going to be about trust, so I'm not going to get into that. We're going to really focus on how are each of these trusts taxed, okay? So these are the questions you need to ask, and then we're going to talk about these different things. We're talking about a third-party trust. Who set it up? That's called the grantor. I'm going to keep this simple. Who granted the money? Who's it set up for those people to put money in? Who's the grantor? Is it revocable or irrevocable? Meaning, can it be changed or can it not be changed? Whose social security number was put on it, or does it have a different tax ID? Okay, so this is your homework. If you have a special needs trust and you're not sure, there's many iterations of this. And sometimes you got to go and look through it and figure out, oh, is this your, people are surprised sometimes when I tell them they have a revocable or irrevocable, or they're surprised to say, oh, my social security number, Oh, the attorney gave me a tax ID. I didn't know that. So let's talk about each one, and Amy's going to talk about what we need to know about them. This one is a grantor revocable trust.
So that means that it was set up most likely by the parent. Let's assume it was the parent who is the grantor. And the parent has the right to change this trust whenever they want. It is intended to pay for amounts over and above what is being covered by government benefits. And because it's revocable, it's taxed to the parent. And therefore, the tax ID number on this trust is going to be the parent's social security number on this particular trust. Pretty straightforward, except every now and then the parents are unaware that they're going to be taxed on the income because they put it in the trust. But if it's their tax ID number on the trust, that's who's going to get taxed with it.
Somebody sent me a note online that says, I have a trust for my child. There's some money put into it and it grew this year. And I got this 1099 with income on it. What do I do with that? Do I have to put that on my return? I said, whose social security number?
Absolutely.
It was her social security
Your
number.
social security number, it'll be on your income tax return.
What if it's a grantor revocable trust? It's mine. I set it up for my son. It's revocable. It's got my social security number. And my brother decided to put some money in it, and he put some money in it and it grew during the year. So you have to pay tax on that?
He doesn't, you do.
Okay. So he gave me a gift of taxes.
Yep, that's how the IRS looks at it. When someone else contributes to your revocable trust, it's a gift to you, and the income that's earned on that money is taxable to you.
Got it. Okay. All right. So now we got another one. It's a grantor trust, and it's irrevocable, and it's also got the parent's social security number on it. How's that work?
Okay, now we're starting to get into fancier tax planning. There's a code section 2056, and under the code, it gives us 5 reasons that a trust that is irrevocable, meaning you can't change it, for income tax purposes only, is considered to be taxable to the parent. For gift tax purposes or estate tax purposes, it's irrevocable and it's not going to be in the parent's estate. But for income tax during the grantor's lifetime, this irrevocable trust is going to throw off income that will be taxed to the parent. They give it a really strange name. It's called an intentionally defective grantor trust, IDGT. And it's a strategy that is used to force the parents to pay income tax on assets that will eventually go to the child and will not be subject to estate tax. So by paying the income tax, we're further reducing the parents' taxable estate. So that's considered a good thing, but it can be a surprise if the practitioner has not gone through that with you very clearly. It might even have an EIN number that's not the parent's social security number. But once again, if it's got one of these 5 powers in it that makes it, for income tax purposes, intentionally defective, the income is going to be taxed to the parent. And it's just such a stupid name, intentionally defective. But we have to live with it because that's how practitioners refer to this kind of trust.
The first time I heard that, and I'm a professional, the first time I heard it, and I was, oh no, we have to go back to the attorney, they made a mistake. So sometimes you hear things that it's not really what it sounds like. But it's important. I think what Amy is saying is the practitioner who did this for you, make sure you ask these questions. Don't walk out the door. Sometimes we're intimidated by professionals sometimes. Don't be, okay? Their job is to serve you. Ask the questions. Just take down these words and say, okay, is this a grantor trust? Is it revocable? Is it irrevocable? Whose social security number? Don't let them do it to you. Ask the question so you are really informed. It's really important because you don't want to have to later find that you would need to change something because of your financial situation. You really do want to know these answers. Okay, so now we get this other one. It's non-grantor. It's irrevocable. It's got a tax ID. What do we do now?
It pays its own tax. It is a taxable entity all by itself. When we say it's non-grantor, that means it does not go back to the grantor. It's irrevocable, meaning you cannot change anything about it. There's always a but when you say irrevocable and you can't change it, because there is an ability to put a provision in this trust where you can name somebody as a trust protector. And their job is to understand what is going to happen in the future. When it happens, they can make administrative changes to the trust to make it work better for all the beneficiaries. That's the one exception to the irrevocable. It has its own tax ID. It is filed as a complex trust, and the trust pays its own tax on the income it generates.
So you need a separate tax return for this.
A separate tax return. It's called a 1041 fiduciary income tax return. It's a complex trust. So instead of the normal exemption we get for individuals, it's very tiny for a trust. It's $100. So you can earn $100 of income in this trust and not pay tax and not have to file a return. But the minute it's over 100, you have to file a return and pay taxes due.
So you see, when you go and get a special needs trust, it's just not a third-party special needs trust, is it? There could be many kinds. It could be set up different ways. I can tell you, we work with attorneys all over the country, and each attorney has their way. You need to understand what they're doing for you. Make sure you understand it. And it's hard when you're not versed in legal language. It's hard. If you have a financial person with you, have them help you interpret it, right?
I ask my clients just, a thing that I want you to keep in mind is I ask my clients, do you ever want to change this document? Because the minute I have the answer from the client, I know what kind of special needs trust I need to draft for them. So if you want to reserve the power to be able to change things in the future, you're not going to be able to do an irrevocable trust. You're going to have to do a grantor trust. So that will determine the path that you're going to take. If you're willing to wash your hands of it and make it irrevocable, then you can go for the special needs trusts that are taxed either to the trust or to you because it's intentionally defective, but it's not in your estate.
Okay. So the other questions the attorney might be asking you, are you going to fund this now? Are you going to put money in it? Why are you going to put money in it? Oh, sorry, I'm just going to take care of this. Maybe talk a little bit next about the first party trust. I'm going to take care of the barking dog right now.
Okay. First party trust is where the owner of the trust is actually your disabled child. And they got money from some kind of, maybe it was from a jury finding or an insurance settlement or something like that. The most important part of this is that the money, if it's distributed for the benefit of the PWD, we have to make sure that this trust reports income to the actual first party. So the K1 from this trust, from the 1041, and the K1 is the form that says how much is taxable. It needs to have the name and the social security number of the first party.
So this is really important. I had someone who came to our office and they said, we have all these problems with our benefits. And I said, well, tell me about that. So they started to pull out 10 years of first party special needs trust tax returns, but every single one of the K1s had the income just going from, you couldn't tell that it was coming from a first party trust. And so we had to refile and prove that those were not actual assets in the child's name because this went on to the child's return, but it wasn't clear that it came from a first party trust. So it's really important that if you're someone who's doing your tax returns, if you have a first party trust, make sure that those K1s are done right. Okay. Okay, let's talk about one last tool, the ABLE account. So the ABLE account came about many, many years ago because we only could have $2,000 in our child's name. And there was a lot of legislation back and forth over the years trying to get some kind of investment vehicle where the child could have money, it could be saved for their future, it wouldn't be taxable, and it wouldn't count against them in that $2,000 limit. So this ABLE legislation was passed. It's a modification to the 529 Act, which sets up the college savings. And it is a very special vehicle. There's reasons that people don't use it because they don't understand it. There's other reasons because it has payback and things like that on it. But I will tell you, there's a lot of federal legislation on the table right now to change a lot of the rules around this. There's some that, your child can only have one account. They're trying to open that up. They're trying to allow you put more in. They're trying to take away the clawback on the back end. So those are some of the things that are being worked on. Not every state has an ABLE, but they're really important to understand because they are tax-free savings as long as you do them right. So if you open up a tax-free savings account for your child and you're funding it, what do they have to know about putting money in and putting money out?
With reference to putting money in, you need to know that you can give up, contribute at least in 2024, $18,000. It is tied to the annual gift exclusion amount. So when they move that number up in 2024 to 18,000, that's the amount you can contribute to the ABLE account. You can only go up to 100,000. If it's over 100,000, you have to quickly spend it down. Otherwise, your child could lose benefits. When you take the money out, assuming it's for, and IRS is really good about giving us terms that we have to define and make sure we keep straight. Qualified disability expenses, QDEs. If you spend it on QDEs, expenses that relate to the disability of the beneficiary, that are for the benefit of the beneficiary, and they help improve health, independence, or quality of life. So it's a rather squishy definition, which I'm very grateful for. Mm-hmm. You take the position, it is in fact a qualified disability expense, then you are required to keep records. And the records that you're required to keep are the same records you would be required to keep for your tax return if you were taking charitable deductions. So you need to have receipts. The receipt needs to have a date on it so that you know when the money was paid out. You need to know who it was paid out for. And on its face, you may not be able to tell what it was paid out for, but you can write on the receipt, or you can keep a spreadsheet saying that the money that was paid to John Jones for the benefit of my disabled son, because he comes and does exercises with him so that it stretches out the muscles in his legs and it improves the quality of his life. So as long as you keep these receipts, and you need to keep these receipts based on the statute of limitations for your tax return. So let's assume that's 3 years. So you have to keep these receipts along with the tax returns that you're filing for a period of 3 years. So this April 15th, 2024, the statute of limitations will close on the 21 return, and you can throw away all those receipts from 2021 and earlier, but you need to keep them for 2022, 2023, and 2024. So maintain your receipts like you would for the IRS and keep them for at least 3 years.
The other thing you can do besides putting in the 18,000 is if your child works, they're also allowed to put up to close to $12,000. So their working income in. Again, you would want to make sure you track that, because if it's working income. The one thing I'll tell you to be careful about putting money in the ABLE is you could also have your Social Security SSI checks deposited directly into an ABLE. I wouldn't do that. And the reason I wouldn't do it is because you're putting your SSI in there, or your SSDI, or any kind of just government benefit. You're limiting because that goes towards your 18,000. And right. So if you really want to get 18,000 from parents or gifts or whatever into that account, don't use it up unless you really need to. Let's say you're your account is getting more close to $2,000, your payee account. You might use it for that, but just be careful that you're using it to the benefit and you're taking advantage of those deductions. So we talked about how much you can put in each year. Tell us about the tax deduction and how does that work?
So are we referring to the tax deduction of the contribution?
Yes.
Because
Yeah.
that's a gift. So the federal government doesn't allow you to deduct it, but states do. So depending on the state in which you live, this particular website, ablenrc.org, will actually let you know whether or not your state allows you a tax deduction. And Illinois allows a tax deduction of, I believe it's 10,000 if you're filing as an individual, or 20,000 if you're filing jointly, as a deduction for what you put into the ABLE. So if you do the full 18,000, you'll be able to, and you're married filing joint, you can deduct the full 18,000 on your Illinois return, not your federal return. So it's an adjustment or a subtraction on your Illinois return to reduce your Illinois income taxes.
Yeah. So not every state gives the deduction. But some people, let's say they know that they're going to have attorney bills, they're going to guardianship, legal bills are qualified disability expenses to get a special needs trust created. Guardianship expenses are qualified. Medical expenses, if you're paying for things that maybe the health insurance doesn't pay for, you can put that money into there, get your deduction, and then turn around and pay like the legal bills out of that account because it's a qualified expense. So a lot of people will look at that, but do it carefully so you understand that you still have the limitation. You can't put all, if I'm single, I couldn't put all 18,000 in and deduct it all. I can only get the 10,000. Okay. Okay. The one thing I want to talk about is some things that get complicated for you, and some of it applies to, you just have to know a lot as a parent, because we're kind of getting close to our time where we're going to start with questions. So some of the things you need to know is when to take your own Social Security. How does that impact taxes? We talked a little bit about you need to make sure that if your income, that Medicaid waiver money is coming in and you're going to take Social Security early. Why would you take it early? You might take it because corporate benefits are going to end. So let's say I'm married and my child and myself are on my husband's medical insurance. Your child can stay on your health insurance, your company health insurance, as long as dad has it. But dad's going to retire at 67. And when he retires, the health insurance goes away. You're like, oh my gosh, what are we going to do? Maybe mom could take her Social Security sooner. But if mom takes her Social Security, at 65, so that in 2 years later, when dad's Social Security goes away, the child's going to be into the Medicare system, and we start thinking about all the complexity of things we have to think about. You got to think about your Social Security, and comes into play when I talked about who's going to be the employer and employee. It impacts all these things, impact your retirement decisions. They're not just little pieces in vacuums. The pension we talked about. Another thing you have to look at and say, how's that pension work? And does it require us to have the child to be a dependent? If they're going to live at home, that's different than if they're going to live in a group home. You can't count on it. All the residential funding options. How are you going? Is it a charitable organization? We're going to be required to make charitable contributions. And is that going to impact your retirement planning? It'll benefit your taxes, but it'll certainly impact the amount of money you have in your pocket for retirement. And then again, if you're starting to fund the tax, if there's trusts and they have to have separate tax returns, all of those things impact not just your child, but you. So knowing those and putting those pieces all together. So we're going to look at one more thing, and then we're going to open it up to questions. What do I have to know about this last new thing that came about called the Secure Act? How does that impact families, Amy?
So the Secure Act, for the rest of the world, it was not a fun thing because they changed the way that you as a non-spousal beneficiary could take an inherited IRA. And it specifically says, since the Secure Act was passed, that instead of being able to take those IRA distributions over your own life expectancy, you now have to empty the account within 10 years. All of it. Doesn't matter. They made an exception, though, for a disabled child. And they said, with respect to a disabled child, that the disabled child is allowed, or disabled beneficiary, I should say, is allowed to take the retirement income over their own life expectancy, just like before. So that's a huge benefit, because we don't want, having to take out this IRA money or 401k money over a 10-year period could blow all of the government funding. And it could really mess it up, because then you'd have to spend everything down. Being able to take it over the child's life expectancy is much, much better. There is a definition that we have to be concerned with, because according to the Secure Act, any disabled or chronically ill person is allowed to use their life expectancy. So disability is pretty straightforward. It can't engage in gainful employment or an activity. They have to have been disabled for a period of time. So that one, you're used to that one. Chronically ill, however, is a new one. And if the individual has been certified by a licensed healthcare practitioner as being unable to perform without substantial assistance from another individual, at least two of the acts of daily living, so eating, dressing themselves, toileting, bathing themselves, there's a few more, there's 7 of them in total. If your child or this person who is chronically ill cannot perform at least 2 of the 7 acts of daily living, they are deemed to be chronically ill under the Secure Act, and they can take their distribution over their life expectancy.
Yeah. Now, if somebody has a very large retirement account and they leave it to their child with a disability, don't forget that that distribution should be going to a special needs trust, and the special needs trust to be checked to make sure that most attorneys will check the special needs trust to make sure it could accept retirement funds and do the stretch. So I always have people do an exercise. Since this passed, many times in the old days, we said, oh, the retirement money is going to make it so complicated for the special needs trust. Let's leave the retirement money to the other kids, and let's leave a bunch of life insurance to the special needs trust. Kind of rethink that now. We say, okay, let's make sure the beneficiaries of the retirement. Now, first of all, you have to know how much you want to leave to your child with special needs or a disability, right? You need to quantify that. Once you've quantified it, and this is an exercise I encourage families to go through. Take your estate documents out and read them. Look at the beneficiaries of your accounts. Look at the beneficiaries of your life insurance. I know it's work, but it's a really important thing when you're talking about the Secure Act, because I want my money to last as long as possible. And if I give my retirement money to my other children, they're going to have to pay the tax faster, and the special needs trust can pay it slower. So I might change my thinking. And so I encourage people to say, pull out those documents, look at the beneficiaries. I diagram it out for myself and say, okay, which money is the retirement money, and who are the beneficiary, and who am I giving it to? And maybe I want to make some switches so that more of the retirement money goes to the special needs trust, because there's a tax advantage doing that now. And maybe I want the other kids to get the life insurance or something. There's no right answer here. What I will suggest, though, is you do this work. Just take a piece of paper, say, here's my wills, here's my trust, here's my life insurance, fill in the boxes, and say, who's going to get what? What I make? How many people remember the beneficiaries on other accounts? Who remembers the beneficiaries of the life insurance? Not many people. Who remembers who their executors are? Who's going to make all this? So because of the Secure Act, I do encourage you to do an exercise and sit down with the attorney who did your documents and make sure that maybe the trust has a couple pieces of language in it. One, to accept allow you to do the stretch still, because you don't have to be required to do the 10-year, but also a special needs trust can have language in it to distribute money from a special needs trust to an ABLE account. And typically a special needs trust cannot do that. But there's language in the trust, because I have a son who's living residentially. His benefits don't cover his housing. Or it covers it, but he has no food to eat, no money for anything else. But I'm not allowed to pay his rent. So I want to make sure when I pass away, now I can put money in into his ABLE account to help him pay his rent. I want the special needs trust. So if I'm not around to do that anymore, I want a special needs trust to do it. So on a regular basis, make sure from a tax perspective that things stay efficient, right? We want to learn what's efficient. We're all not going to be here forever. So we've taught you a lot about taxes. What do you have to tell other people? Because if we're not here to pass this information on, what do we have to tell them? Who do we have to tell? And when do we have to tell them? So if we have people in our legal documents, we're picking for guardians and we're picking them to be trustees, they got to know what we talked about tonight. You know, you give us questions all the time about how's that waiver money work? What is this? How is this trust taxable? How am I supposed to know that? Start documenting it, learn it, figure out who has to know, tell them, and tell them now. Because if you're not here on the planet tomorrow, I don't think there's any way to communicate yet to tell somebody when we're gone. All right. So we have some time, a few minutes for questions. And if there's a lot of questions, we will take them from the chat and we will answer them and get them to Kathy so she can distribute that. Do we have some questions we might want to answer? No.
We do. We have quite a few questions. If my child who is over 18 has a first-party special needs trust due to child support paid to him, does he need to file a tax return for the money spent from the trust for his behalf?
If it is, so it's a first party trust. The answer is only income earned on the contributions. So the child support itself is not taxable, but when you invest the child support money inside that first party trust, the income that is generated on the child support will be taxable to the first payee. So obviously the child.
Okay.
Good question.
How does claiming your DAC as a dependent who receives SSDI only affect their Medicaid redeterminations?
Ask that question again. How does the DAC impact their Medicaid redeterminations? First of all, when you're doing the Medicaid redeterminations and it's a financial determination, you're going to have to, first of all, DAC. Sometimes your DAC is high, and sometimes you find that Medicaid is telling you that your income's too high. So I will tell you there's something called the Pickle Amendment. And if you went from SSDI or SSI and SSDI, and you got this bigger check from DAC, the DAC is not supposed to kick you off of Medicaid because of an income too high. So recognize and just remember when you have to Medicaid redetermination, they come and say your income's too high because of DAC. Remember that phrase Pickle Amendment? It's named after a man named Mr. Pickle. And Social Security Medicaid should know what that means.
Thank you. Did you say if I'm a PSW and I'm not taxed, I can still get an IRA? My tax person said I couldn't.
If you are getting personal support worker money, it is considered earned income, and therefore it can be used as for contributions. It is income. So it's not taxable income, but it is considered earned income, which is what you have to have. Again, this is something that sometimes your CPAs and need to be a little educated. And so we're always happy to send them some information if they need it.
That's great. Can you decant an existing trust in a disabled child's own name into a third-party special needs trust?
I'll let Amy.
I'm only laughing because of the decanting provisions. I want you to send me that question in specificity and who sent it, and I will answer it, because decanting is pretty high up there in terms of sophistication.
Illinois allows $10,000 to be put into an ABLE account to be deducted. What if I live in Illinois, but the ABLE account is in another state?
If you're making the contribution and you live in Illinois, you get the deduction in Illinois.
But if you're making it to an ABLE account in another state, you would not. It's only the ABLE in Illinois that allows deduction, I believe. So if
Oh,
I'm making
correct.
if I'm making a contribution to Utah's plan or another state, I won't get the deduction unless that state allows residents, non-residents to get a deduction.
Which wouldn't make any sense because you
Right.
wouldn't have any other income to declare in that state. So
Right.
the deduction would do you no good.
So what you need to know about ABLE, though, is ABLE is a federal legislation administered by the state. Every state doesn't have to have an ABLE, but some states, Illinois, anybody can use Illinois. Wisconsin didn't have one, but they just signed some legislation to have one. They don't have it quite yet, but it's in the process. And Florida's only Florida residents can use it. So every ABLE is important to understand and where you live. So if you're using the one in your state and that one gives you deduction, you'll get the deduction, but you can't put it in Florida's or another state and get the deduction typically.
Okay.
Okay.
If our loved one is working and earning $2,000 a year, do they have to be the one to contribute the additional $2,000 over the $18,000 to enable, or can anyone make that additional contribution?
It's a limit of 18,000.
But
So
if the
I'm not
child-
sure.
Yeah, if the child's making 2,000 in addition, 16,000 could go into that account. But doesn't have to go from the child's specific name into the account. But the child will be eligible to put earned income into it. So if the parents are, I don't know, Amy, if the parents would have to come directly from the child's account to go in there to be counted as income from the child, that's a question I'm not exactly sure.
You'd probably have to be able to trace where it came from,
Yeah.
but you won't get an additional 2,000 because the child's working and wants to contribute it. The max you can put in is 18,000
Well, no,
from whatever source.
no, that's not true. I'll
Oh,
clarify
I'm
that.
sorry. Go
Yeah.
ahead.
So you can put 18,000 from any source. And you could put, the child can put an additional 12,000 of their income over and above the 18.
Oh, you're right. I'm sorry for
Yeah.
that one now.
Yeah, but the parents can't put 20. The parents can put 18. Or the child can put 12. The child can put 18 and 12. Right? Because anybody can put the 18 in.
Right.
But only the child can put their income in. So the child can put 18 and the child can put 18 and 12 in, but the parents can't. Right.
With the Secure Act using life expectancy of the person with the disability, who determines that life expectancy?
There's actually published tables, and the IRS does not require either a disabled or chronically ill person to use a shorter life expectancy. It's based purely on age.
Right.
Okay. Can you address Medicaid eligibility for a dependent on your tax return? What about SSDI and AABB?
I'm not quite certain what the question is really asking. So we
That's all
talked
I
about,
have.
okay. Maybe if
maybe
the
they
person
could-
who asked the question can send us a note or put in the chat box more specifically.
Yeah.
Marianne, do you know what they're asking?
I thought maybe they were asking when we're talking about deductions, and you can take deductions for somebody, is the standard if they're getting a disability, would that be considered good enough to be considered a disabled individual and take the for the parents to take the deduction? So if the child gets SSI, the government is to proclaim them disabled. I would probably on their tax return, that would be a good enough definition. That's what they're asking. I'm not sure.
But the IRS actually has adopted the Social Security definition of disability. So it's the same. If you get SSI, then clearly for IRS purposes, you're disabled.
I'm not sure if that was the question though, so maybe they could clarify it.
Is a pension considered income for my son with a disability? As a bagger and union member, he's going to receive a pension when he turns 60 from the union. He's on SSDI and is in a Medicaid waiver.
Pensions are always considered income.
Now remember, the asset and income are different. So if he's disabled, he also still has to meet the substantial gainful activity test for disability. But the asset limit for Medicaid is different now. It's 2,000 for Social Security and SSDI, but Medicaid now has a $17,500 asset limit. It's higher. Just went up recently.
If we, as the trustee of a special needs trust, give money to the guardian of a disabled child, does he have to pay taxes on it?
Are they giving the money to the guardian for the benefit of the child, or are they giving money to the guardian because they're very happy with the guardian?
And is it a gift or is it paid? Because I don't think a
Again.
special needs trust gift money to people,
It
has
generally
to-
will not have provisions for that.
but it can pay for caregivers. And I guess the question would be, if a special needs trust is paying salaries for caregivers, I would expect that would be income.
It would definitely be income.
Yeah.
I think we have time for one more. Can my son who lives with me but still gets SSDI still be claimed as a dependent on my taxes? Or will that affect his Medicaid benefits, since he is a household of one for the sake of his Medicaid benefits? Do I claim him or not?
I don't know the answer to that one. Do you know, Marianne?
Mary, would you repeat that?
Sure. Can my son who lives with me, but he gets SSDI, still be claimed as a dependent on my taxes? Or will that affect his Medicaid benefits, since he is a household of one for the sake of his Medicaid benefits? Should I claim him or not?
If you are providing, I guess my first question would be, are you providing more than half of his income? I think
half
I'd
of his
want to
support.
know, half of his support. I mean, that would be the first question. But if you're providing half the support and he's got that would probably be a problem. He's a household of one. I think it's a further question. It's a very specific question. I'd rather get a little more information and answer that here. Because it probably is very dependent upon a couple of things. Okay. So if we can get that person's information, we can try to get a little more detail and answer that more specifically.
Okay.
Okay.
One of our participants had asked at the end of today's session if you would have some recommendations on CPAs who may be well-versed on the unique tax scenarios that we face as parents of children with disabilities.
We are trying to gather a list of CPAs around the country, just like we are doing as we go forward at Protected Tomorrow. Is one of our initiatives in this coming year, is to start to gather professionals who have this expertise. You could, because attorneys are easier, but attorneys has all kinds of groups that attorneys belong to. Amy, do you have any advice on CPAs around the country who have this expertise?
Well, what's interesting is I was a partner at Ernst & Young for a number of years, and we did not have anybody except in our New York and our New Jersey office. And all of our disability questions would go to these two experts. I think every large CPA firm generally will have one or more people on their staff who are well-versed in this, but I don't know of a single firm that actually specializes in special needs where it's a niche practice. So my recommendation is go to a bigger firm, because the larger the firm, the more resources. The smaller firms just don't have the resources and manpower to be able to specialize in this area.
And even if a CPA has a one person practice and they have a child with a disability, they might know it, but they may not have the time to keep up with all of it because that kind of a practice is just so overwhelming at tax time, right? One of the things we are hoping to do at Protected Tomorrows, and we're starting an initiative, is we have a training program for financial professionals, specifically CPAs, divorce attorneys, family law attorneys, bringing in people who know it and having them help us teach. I will tell you, family law judges don't know it. There's just a lot of people in the financial world. We did a case with a judge in Maryland, and he says, I've never heard of this special needs trust before. So it's not just CPAs, it's many professionals who just don't have exposure to this yet, but we are going to try to find the CPAs in the country who do have expertise and build access to them, or start to train CPAs so that they're more versed in this. It's unfortunate. You can't just go to the CPA down the street. You got to ask the questions. It's like anytime you hire somebody, we have to, as parents, have to ask the ESSER questions. So maybe today give you enough questions. And we have a checklist of some of the things you can ask, and we'll try to get that to Kathy so she can include it with the recording. Okay.
That's great. We've got one more question. Can an ex-spouse claim a dependent on their taxes even if they are with the other biological parent 100% of the time?
It's going to depend on the divorce findings, because a lot of times in a divorce, a judge will, or the parents will, agree to allow one spouse to claim, even if it's not the custodial spouse. So that's the first thing you have to overcome. Are you the custodial spouse, or is there even any mention in the divorce decree regarding who gets to claim? If there's no mention in the divorce decree, then you have to add up support. And just because that dependent is living within your household, if you are providing more than X amount in their support that exceeds their, living in the household, you are entitled to claim them as a dependent. It's the exception to the rule of when you can claim a dependent that doesn't live in your household.
And don't forget, if you're divorced and you're paying child support, and the child support's for the benefit of that child, when the child turns 18, the child support is theirs, not the spouse, not the parent. And so
goes into that
first
needs trust.
It needs to be the court order. The court order has to be produced in order for that special needs trust to go, the child support to go to the trust, and it's a first party trust. And then of course, then you have a first party trust. That's where the question came up about taxation. So just be aware, because I reach people all the time with the child support, working on a case right now where the child's applying for benefits, but we have to delay it because the child support's going to the child, and the court's they're not going to approve the SSI. So lots of little details we have to know. That I've been doing this so long, sometimes I'm going, I can't believe we're not getting the word out yet. But yet, why would you know it, right? If you don't have professionals surrounding you who know this, it comes to you as parents to keep asking questions and keep asking questions. If there's things we didn't answer today, I would love you to give us feedback so that we can get answers to you, because it's important during tax time, and you're trying to get your taxes done is stressful enough, and to not get right answers is just puts a burden on the parents. So let's try to get you to people who can answer the questions for you. Thank you.
Marianne, I think you did a good job with Amy getting the word out this evening. So thank you very much for shedding a lot of good light on a very complicated but important topic. Your expertise and your insights have been invaluable for all of us, and we want to thank you very much. For those who want to learn more about Protected Tomorrows, we'll share their contact information in an email with the recording. And as some of you may be aware, this presentation is the second of 3 educational Zoom webinars we're hosting this spring. next month, feel free to sign up on Wednesday for a seminar on Wednesday, April 17th from 7 to 8 p.m. for an informational hour with founder and president of Oak Wealth Advisors, Mike Walter. He'll be sharing how to optimize the use of ABLE accounts and special needs trusts. So we encourage you to visit the CIF website to register for those upcoming upcoming webinar. So thanks again to everybody for joining us. Thanks again, Amy and Marianne. It's very, very, very helpful. And we wish everybody a good night.
Good night, everybody.
Good night
Good.
and thank you.